Hello, welcome to a webinar where we're going to actually talk through, take you through some of the trading strategies or learning how to trade stocks, options, and futures on StockTrak. So I'm going to, I see we have 10 viewers here, so I'm sure that's the allocation that we might have for the Hangout. So if people are actually having difficulty trying to access the Hangout, you can actually go to a link in which I've posted on. I actually emailed it to everybody who were attending. You can actually go to economicrockstar.com/learn -trade-stock-markets. Okay, so I'm just going to take you through to. I'm just going to share the screen. Where have I? And we have here the StockTrak platform. So if anybody can maybe if it's possible to send a message or anything like that, you might be able to let me know if this is actually clear. So okay, so we're going to have a look at the trading platform where we're going to analyze how we'd actually trade stocks. So we're just waiting for this to load up. Okay. So StockTrak gives us numerous platforms on which we can actually trade in terms of North America and Europe and Asia and so on. So this is quite familiar to a lot of you, but in order to maybe purchase a stock, we'd have to put in a buy action as opposed to maybe a sell action. So a sell is just something that you might want to close out a stock position in which you've bought initially. If you believe the stock price is going to fall and you want to profit from it, then you'll go to a short position. And in order to close that out, when you want to close out your position, you cover that. So just briefly, I'm going to take you through buying a stock, and then we'll move on to options and futures soon enough. Okay, so I'm going to just take the symbol Google. And we'll put in a quantity of, we'll say 100 shares. And because the market is possibly still open in the United States, it's about to close, we're going to take the market price for Google stock, which is currently $561.32. And we just preview that order. Okay, the estimated cost based on 100 shares, we're told here is 56,000 approximately, and I place that order. Okay, so we're just showed a confirmation of 100 Google shares being purchased. So again, I'm just going to take you through briefly how you'd actually trade a stock regarding shorting the position, just in case you might believe that the stock is actually going to fall in value. So I'll place a new order, and I'm not looking at any particular fundamental or technical analysis at the moment, but that's really that for another time. When we look at possibly trading strategies using technical analysis, but just to illustrate how we might short the position, if I believe Apple was going to fall in price, I would short that stock. And again, I'll choose 100 shares of Apple. When the market's still open, I'll take a market type order, which is the price that's available at this moment. And we see that Apple is trading just over $100. So that seems to be sideways trading for quite a while over the last 3 or 4 weeks. And it might be hitting some resistance level at approximately 102 or 3. So I might feel this an opportune time to actually short this particular stock. Preview the order, see everything is good to go. short this. Okay, so I currently have a long position in Apple, and they're not allowing me to, for some reason, not short that stock. So I'm going to choose another stock. We'll go with IBM since the ticker symbol is actually given. If you're unsure of the ticker symbol, you need to look it up here, and you can type in the actual stock. I'll do that in a moment. And so the ticker for IBM is IBM. And they're allowing me to short 100 shares of IBM at $186.78. Okay, and that's a success. Now, obviously, you could get things wrong when you're trading in the stock market. So you would like to possibly put in a stop loss order. And a stop loss order allows you to protect yourself from taking on too much losses if the trade actually goes against you. So given that I shorted IBM at $186, I need to cover that position. So that's like buying it back once you've shorted your position. So I need to cover IBM, and I'll take all 100 stocks that I need to cover my position. And I'll take the market. Sorry, I won't take the market. I'll put in my stop, which is a particular stop value that I could put in, or a trading stop. I'll put a stop for this one, which is one particular price. That won't change if the market price of IBM changes, and I need to keep on reevaluating my stop price in order to change it along with the change in the stock price of IBM. So if IBM is 186.78 at the moment, I might put in a stop price of, we'll say 191.50, which is a price higher than the current price. And the reason why I put it in at a higher price is that if the stock price goes up, I'm losing money because I've just shorted IBM. I short IBM in order to gain on the downside. So if IBM continues upward, at least I'll be triggered out and stopped out of my position at 191.50. Therefore, not taking any more losses if that stock price continues upward. So I need to put in a good till cancel order term. If you leave it at a good till day, it means that at the end of the trading day, which is soon enough, this stop loss is no longer active. So you need to put in a good till cancel, or put in a specific date, a good till date. So I'm happy with the good till cancel, and I'll preview my order. Okay. And it requires an existing short in IBM. I'm just going to go back and see what my open position was. I'm sure I shorted IBM. Okay, the connection is quite slow here. Just going to take it back. Okay. You make the assumption that I just completed that trade by shorting. I would put in my stop loss at that short position to cover it. Okay. If you were required to, if you did not want to actually keep on checking the market and putting in regular new stops, where you had to stop at about $191 for IBM, and the stock price does fall, you might like to bring your stop down with that price fall. So in order to try and capture some of the gains in the market if the stock falls and you're gaining on your short. So what you might like to do, instead of re-entering new stop losses, you might like to put in a trading stop in a dollar amount. So the stock was $186, and I put in a $191 stop, which is approximately a $5 stop loss distance from the stock. So putting in a trading stop of $5, if you wished, you could actually put that $5 symbol in here. Or you might like to work as a percentage and put in a percentage, maybe like 1 or 2%. Okay, so that should allow you to activate a stop loss that actually will hold. I suppose the stop loss will be good until it's actually cancelled, and you won't have to worry about having to change stops, or if the market trade goes against you, to accumulate all the losses, so you're out of the market if you're wrong. Okay, so I hope that brief introduction on trading stocks itself was within your previous background on what we've worked with to date. So buying, if you're believing the stock to go up, and closing your position to sell. And if you want a profit on the stock falling, you go with a short position, and to close out your position, you cover that. And make sure then you enter into a new trade where you actually want to, instead of buying or selling at particular prices, you want to put in a stop on stocks that you already have. Okay. So the next event, what I'm going to do here is trade down to futures. Okay. I just want to switch back on the screen just to see how if there's anybody with questions. Okay. Anybody has any questions? Why can I see anything here? Okay. Okay, D Zhao cannot see anything on the screen. Maybe we've too many viewers. And if D Zhao, if you can hear me, if you would like to, I sent an email out to people about 2 hours ago with a link that you could actually follow. The link is economicrockstar.com/learn to trade stock markets, and between each word you have a hyphen. So learn to trade stock markets should allow you to follow us on another platform. Okay, I'm just going to go to trade futures. Just briefly again, what a futures is a financial derivative, which means that we can participate in markets like stocks and commodities, but not actually own these stocks or commodities. So we're participating in the price action, and we want to gain from price increases or price decreases by almost like buying stocks and shorting stocks. We can buy and short or sell futures contracts, and any gain in the commodity will result in a gain for you without you actually owning or taking possession of the commodity. So that's why it's called a derivative, because it's derived from the actual price action of a stock or a commodity. Okay. Okay. In the StockTrak platform, we have the United States and European futures markets. Okay, so I'm just going to go back to the United States. And within that, we have certain categories in which we can actually trade futures. So they're categorized as indices in terms of like the S&P and the NASDAQ and the Russell. We have currencies, petroleum, metals, etc. Okay, so again, if you wanted to trade futures using any one of these, and for example, if you wanted to participate in the metals market, but the price of gold is approximately $1,200 per ounce. So that could take up, to actually take physical ownership of gold, that would take a lot of capital. Okay, so what the financial derivatives market allows you to do is take, I suppose, virtual ownership of an ounce of metal, an ounce of gold, and for a very little amount of money called a margin that's required for you to actually participate in this trade. So by you trading, buying into, say, for example, an ounce of gold, and gold goes up $100, then you should, without actually owning the physical metal, you had owned a contract, you had bought into a futures contract and you should also gain $100 on that trade. So say, for example, I'd like the idea of buying metal or buying gold. We are given a number of precious metals here. I'll go with the gold. And we're told that for the month of October 2014, the last price of gold is $12.25 and a day's change of $19.70. Okay, so that's a phenomenal jump in the day. And we see here the multiplier. We're told that gold, one contract of gold is 100 ounces. So each futures contract, you cannot trade a small quantity of a commodity. They're actually grouped into contract sizes, and gold here has a multiplier of 100 or 100 ounces. And oil, for example, one contract of oil is 1,000 barrels of oil. So if you were to actually buy 100 ounces of gold, okay, it will cost you $122,500. This last price multiplied by this 100. So let's say, for example, that I wanted to buy 100 ounces of gold. I'd only have to put in one contract as opposed to 100. Okay, I go with the market type if the market is still open, and I preview that order. If it doesn't go through, I'm going to put in a limit, or a limit whereby the market is closed, and I'll hopefully get a decent price when the market opens tomorrow. Okay. Now, the $122,500 that I mentioned, if you were to buy 100 ounces of gold, did not materialize in what was actually required of me to deposit. And given that this is virtual currency, or not virtual currency, but given that this is paper currency or paper trading, there's a clearinghouse that exists in a futures exchange whereby buyers and sellers of the same commodity will deposit what's known as a margin in the account. You're not required to put in the full amount because you're not taking physical ownership of the gold. So $8,710 is actually only taken from me. Okay, and this is what's known as leveraging. Okay, I do not have to put in the $122,500. So I have a lot of that on deposit in cash if I actually have that amount of money to work with. So I could place that order. If that's gone through, so that has gone through. So I placed that order, and now I have the equivalent of 100 ounces of gold if I believe gold to continue upward. And like trading stocks, we can lose a lot of money if the price of gold has actually fallen. Okay, so we're aiming for, having bought gold, we're aiming for gold. I don't know if, let me see this for a moment. I don't think I was sharing the screen there. Okay, so what I was doing was buying an ounce of gold, and 100 ounces of gold, which is the equivalent of one contract, only cost me $8,710. Okay, so that I was able to enter this market on huge leverage. So like stocks, you need to put in a stop loss position. So gold can actually fall from your purchasing position, and hence you need to protect any subsequent fall that might materialize. So I'm going to place a new order, and having bought futures contracts in October for metals and gold, I need to sell out of my position with a stop. And if I believe that gold could possibly fall below, for example, a $1,200 level, I might like to put in a price that would stop me out of the markets just in case gold continued to fall. But you need to make sure that the month that you're specifying here is exactly the same as the one in which you bought the futures contract for. If you change this to any other month or any other year, it won't allow you to put in the stop loss. So I'm going to put in the 1 unit or the one contract, and I'm naming my price that I'd like to be stopped out. And again, this is a go till cancelled, identical to actually trading stocks. Okay, and I can place that order. So now I've just signaled to my account that if price of gold actually fell to $1997, I'm stopped out of the market, and if it continued falling, at least I'm not being hit with all of those losses. Okay, again, I place a new order, and in this case, what I'm going to do is create a short position in the futures market. And again, a short position is one whereby you believe that the price of the asset will fall, and hence you want to profit from that fall in the asset. So again, I'll go with petroleum in this case, and I might go with crude oil, light sweet crude oil. Again, I have no particular reason as to why I should go with this, but I'm just going to assume that this is what I believe based on maybe some fundamentals or technical analysis that I've seen previously. Now, it's not allowing me to choose this particular contract, so I need to go further out in order to trade a particular some of these contracts. So we're seeing December 14 here at $84.08. Okay, so you see oil has fallen by $2.51 in the day. Okay, so maybe I might believe that this is going to fall even further. So I'm just going to take this out. And again, we see the multiplier, like gold had 100 ounces per contract. Well, crude oil will have 1,000 barrels of oil per contract. Now, if I was to actually buy the oil, take physical ownership of oil, it's going to be $84,080 would be my total cost. But that's not required when you're trading futures. All you need to do, and I'll put into 1 unit, which is my 1,000 barrels. Okay, it's again, I already have a position with oil, so I'm going to just change the month. To allow me to take that short position. The year. Okay, March 14 didn't exist because we're gone beyond that, and futures markets, we need to look into the future and see what the expectation of the price would be. So again, the last price here for March 2015 is 83.14 with a similar dollar drop as the December 2014 contract. Okay, so pretty much everything stays the same because futures have specifications in terms of the number of barrels of oil per contract. That wouldn't change at all. So I'm going to short March 15 at market prices if the market hasn't closed yet. Okay, and all that's required is $4,420 as opposed to $83,140, which is the last price by the 1,000 barrels. So I'm getting it for approximately 5.5%, and that's all that's required, and hence I may be attracted to over leveraging my position. And because I have in this account $1 million to trade with, I could actually buy multiple barrels of oil and take on potential risks in terms of the oil price going back up, and that goes against my market short, or I could receive large gains if the oil price actually falls, and I'll profit a lot more with my larger quantities if I want to change my order and maybe put in 10 contracts here. Okay, and that was a success. So I have 1,000 barrels in the form of 1 contract of oil, shorted at a price of $83.14, and it only cost me $4,420. Okay. So I might want to place in a new order, and we see multiple commodities that we could trade with. So again, with food and fibers, you might, based on some study or analysis that you actually have taken out, you might find that there is a shortage or maybe an oversupply predicted for a particular, say in this case, orange juice. And based on what the market is signaling to us, we might actually trade and possibly buy if we believe there's going to be a shortage, or short if we believe there's going to be an oversupply, because the supply and demand in economics may affect the prices here of a commodity yield based on the yield of a commodity. So I'm just going to assume that, okay, I like the idea that we're going to buy orange juice, and I'll go into a month in 2015, if it allows me to do so. And they're telling me that's not currently trading in the markets. Okay. Whether that's because it's closed, or I'll try another, just in case. Okay, so I'm going to trade sugar for whatever same reason that I've given for orange juice. Okay, 18 cents for your sugar, and no particular day change, and we have 112,000 pounds of sugar here. So I might buy, we say, 2 contracts of sugar at the market order, and again, believing that the price will go up, I'm going to buy sugar and gain from it, possibly. Okay, all that's required is $1,600. Okay, which is just a margin. And obviously, if you're losing, you need to deposit more. It'll automatically occur. You'll actually deposit more money in the margin account. And that's being placed. And what you should be doing once you make those trades in the futures markets, make sure you put in a stop loss order. So I had bought sugar, and I'm going to sell it back, sell out of it. I think that was the month, October 2015. And if I want to close out my position, I might want to put in a stop, just like the way we had done with the stocks. And the reason why I would, because I've initially bought it, I'm going to put in my stop below my purchase price, because that's where I'm making the losses or potential losses. So I might put in 165 as the price of sugar that I'll get out at if the price actually falls to this level. And I put that as a go till cancel. Okay, so I obviously went for a different month. I'm sure I went for October. Okay, if you're unsure, which I'm not going to do, I'm going to continue on, but if you're unsure, if you hover over your My Portfolio tab, you'll see a drop-down menu, and you should be able to see here an open position or your transaction history. Okay, maybe I'll just click into it just in case and see what I actually have done. Okay, crude oil. Okay. This was, we see sugar down here, but that was something I had done previously. I had bought it at the 16 cent level. We don't see sugar in there, so maybe it wasn't activated at all. Okay, so if you just remember that futures is pretty much traded like stocks, and you know, you need to put in your stop losses, and all that's required is a margin, so you don't have to put up large volumes of money in order to participate in the markets. I'm just going to again go back to the screen, see if there's anything. Okay, thanks, Christina. You can't see the future screenshot. I'd assumed that that question was posed just before I realized that I actually wasn't sharing the screen. So hopefully you actually see the screen at the moment, and you can actually hear me quite clearly. So I might have gone through this quite quickly, but to briefly explain the whole idea of futures again, is that if you believe prices to, we'll assume, rise into the future, the futures market will give you prices that reflect maybe that whole idea that prices will be higher in the future. So I just briefly show you what we'll say silver might look like. And we have silver for December 2014, and the current price is 17.36, which means that the price of silver, based on today's market conditions and whatever expectations there are in the market that's reflected in this price, they'll expect silver to be 17.36 for December 2014. And obviously that can change over time. If we move out again into the future, say we quickly go to January 2015 if it's available. Here we see a 17.36. Okay, and again, if we continue further again, okay, it slightly goes higher, 17.39. So typically, as we scroll into the future, the price for the commodity should rise. So again, July of 15, and we see it going up. It seems to be going up by about 4 cents each month. Okay, and there's a drop in September 2015 and December 17.79 again. So September seems quite attractive as a price compared to others, but if you notice the date change, they're almost somewhat similar. They should be anyway. Okay, there's quite a large change. So it's strange that September actually saw a decline in prices, which can happen. Okay, so these are just in a normal market condition, future prices month on month should be higher than the previous month, and it's something that we saw here except for September 2015. So the reason why futures prices should be higher in the future is because there's a cost of carry to holding onto a position. So if you own silver, actual silver, the silver commodity, then you need to store that, which means putting in taking out insurance costs on the silver, paying for a facility in which you need to deposit that silver, and there are costs borne on you, so that in say 1 year's time, and those costs which have accumulated should be added to the price that you had paid for previously, and therefore that initial price that you paid for plus the cost of carry should pretty much equal the price of what silver should be in a year's time. So if we just again look at December 2014, and the price is 17.36 per ounce, and we have 5,000 ounces in a contract. And if we fast forward 12 months, have a look at the price here. December 14 is 17.36, but December 2015 is 17.79. Okay, so that 43-cent differential is assumed to be the cost of carry, or the cost of storing silver. Okay, so if you bought silver at December 2014 prices 17.36 and held on to it for 12 months, or because it's now October, but held on to it for the 12 to 14 months, it should cost you about, what did I say, 36 cents or 46 cents to actually store that particular silver. Okay, but that happens in normal conditions, and it doesn't happen in every market. And typically oil is one market where you wouldn't actually experience a normal market condition. So say, for example, we just go into petroleum and see what oil is actually doing. We'll go with the light sweet, which is WTI. Okay. So let's go with a December futures contract. With some of these futures, you might see there are errors loading up, and they're usually only traded every quarter. So March, June, September, and December contracts for crude oil, whereas other commodities can be traded on a monthly basis. So with crude oil here, for December 14, you have 83.64, and it's just going to go through a couple of months into the future in 2015 to see what the price would be we'd expect, because it's a commodity, somewhat like silver, where there's actually cost to storing it, we'd expect the prices to be higher month on month because there's a storage cost involved. And at times, crude oil does not follow that particular reasoning. So January 15, 83.25. So that seemed to be a slight drop on the December 2014 contract. Again, we'd be able to see the price moving from January to, say, February. So 83.25 to 82.98. So there's a drop. So we had expected, theoretically, it should be the case because of the cost of carry model, that this price should be higher into the future. So if you go June, okay, possibly September. Okay, slightly. There seems to be a reversal of what's going to happen in the future. Okay, declined again. Okay, so earlier on I looked at this trade. Yesterday I looked at this trade, and all of the prices seem to be smaller than the previous month. Typically, that might indicate to a trader that the future price for oil is going to drop, and hence they may put in short positions because they want to benefit and profit from falling prices, because there's an expectation built in that future prices will be lower. Okay, and then hence you can buy oil at a cheaper price and buy it back and gain a profit on that. If we knew as consumers of oil, like for example home heating oil or something like that, if we knew as consumers that the price of oil was going to drop, we may delay our purchase because we know that we're going to get a cheaper price. So suppliers are aware of this as well. So suppliers like BP look at the futures markets and they see that the prices have actually dropped into the future, which will actually affect their turnover and their profitability. So hence, what they could do is stop, turn off the taps, essentially turn off the taps and restrict the flow of oil. And what that would do is reduce the supply of oil, possibly meeting demand or even creating a shortage. And on a weekly basis, supply and demand for crude oil is announced onto the markets, and one day, soon enough, it'll reach the markets that there's an actual shortage in oil, and there'll end up being a reversal in this type of market, where we actually experienced some of the months into the future, the price is actually lower than the previous month. It was the case yesterday, and that for traders seems to be a bullish indicator that prices were going to turn around, because they can anticipate the supplier's action or potential action. And that's why when I was looking through the latter months, there seemed to be a reversal or a slowdown in the price action into the future. So some of the prices started to get higher than the previous month, which is theoretically, it should be the case theoretically anyway, because of the cost of storage model. So yeah, so that's the futures contract. Again, I've possibly gone through, hopefully I've gone through it okay with you. And again, I'm just going to switch around and see, is there any questions? Okay, Christina, right. Can't see the future screenshot. Okay, Christina, you're asking again. What I would do, Christina, or anybody else, if that's the case, if you could, maybe there's so many people that I'm unsure what the problem might be here, but possibly there's a capacity limit to how many people can actually view the screen. I think there's up to maybe 10 to 11 that can only view the screen. So what I would recommend other people who cannot view it is to visit economicrockstar.com/learn to trade stock markets. And between each of those words, there's a hyphen. So learn to trade stock markets, and you definitely should be able to see it there. I know it might be frustrating on some of you who cannot see it, but hopefully it'll be available on YouTube. So I want to go to options and explain how options can be traded. Okay, so futures, remember, futures can be traded very much like stocks, and you put in your stop losses, whether it's above the price if you're shorting or below the price if you're buying. So options is another derivative And again, what we mean by a derivative is that you do not have to actually own a commodity or a stock in order to participate in um, the gains or the losses of that particular market. An option actually allows you to trade and participate in potential gains or losses through having, I suppose tracking the price of tracking the price action. And if you believe that the stock or commodity is going to rise in value, then you can trade an option and benefit on almost as if you actually had the stock or the commodity. So an option, as the name, we're told that the market is closed, so we're going to have to we cannot use the market. So this is a good example of how we could actually put in orders that may be activated tomorrow. So an option is like an insurance policy, and it allows you to enter into a contract. It's just like the way the futures contract that we entered into. The futures contract had a buyer and seller, and you had to fulfill the obligation no matter what side of the trade you were on. With an option, you also have a contract between the buyer and seller of that particular contract. But the buyer seems to have more benefits than the seller, because the buyer has to pay the seller a premium, like an insurance premium, against events that might occur. And if the seller if it works out for the seller keeps the premium. But if it works out for the buyer can have a lot of gains. But if it doesn't work out for the buyer can walk away from the contract because it paid for the option to do so. So we can go with a simple option. And options are classified as a put or a call. And you might see it here, calls and puts. I'm just going to concentrate at the moment on buyers here as opposed to selling. So I'll be looking at buying to open and selling to close. So I'll be a buyer of an option as opposed to a seller of an option, because you need a seller as well as a buyer. So you have sell to open and buy it back to close. So you need to do the opposite to your trade. Once you initially entered into, say, a sell position to open, you need to buy it to closes. So I'm going to buy to open, and I'm going to be looking at stocks here. Because when we looked at Apple was about $101, just over $101 in value. So I might like to buy, say, the equivalent of 1,000 shares. Okay, so that's going to cost me $101,000 to actually own the shares. So that's a lot of money that I might consider that I could risk. I could risk a lot of that if the stock actually went against me, or I might prefer to diversify my portfolio into other stocks or commodities. But buying Apple will actually take up a chunk, or if not all, of my capital that I might like to invest in. So options are a great way to actually try to allows you to diversify by actually putting up a smaller amount of capital, but still being able to benefit from the price action of Apple stock. So like a futures contract, where by one contract was the equivalent to a specified amount of, say, 1,000 barrels of oil or 100 ounces of gold, option contracts also have a size in terms, when you're dealing with stocks in the United States, they're 100 stocks. So if I wanted to buy, as I said, 1,000 Apple shares, I would buy 10 contracts, because I know that each one contract has 100 shares. So I'd have my 10 by 100 shares, which is my 1,000. So I'm going to be buying Apple. I know the Apple's ticker symbol here. If not, you can look it up. And if I believe the price of Apple is going to rise, and I want to just trade Apple, I will buy, if it allows me, I would have traded a call option contract. So possibly it's not allowing me to do so, maybe due to the market being closed. So I would have bought a call option, and then we'd be given a chance to trade on a particular expiration date. So with option contracts, you have a finite period to actually participate into this market. So say, for example, like the futures market, there were months. you're also going to get the same for an options contract. So you believe, say, over a 3-month period that Apple stock could possibly go up, but you do not want to commit your $101,000 to make that trade. So instead, you do the equivalent of owning 1,000 shares. You wouldn't physically own the 1,000 shares. So you would effectively put in your 10 contracts, which is your 1,000 shares. You buy your call option, and maybe over the next 3 or more months, you will select an expiration date, and you will have dates here, which are months. Okay, so you'll be going into 2015 in this case. So you might be able to select a January or a February 2015 expiration date, which means you can hold on to this option contract up until that period. But after that period, the option contract ends. And if you're up, you'll gain. But if you're down, you lose your options premium. I'm going to explain that options premium in a moment. It's like your insurance that you had to hand over to the seller. Because it's not allowing us to view what the strike price would be. What a strike price is, you will be given what's called an options chain, and that will have numerous strike prices. And for simplicity, we take the strike price that's very close to the current stock price. So the current stock price is $101. You would choose a strike price that's $100. They tend to, at that high price stock level, they tend to go up multiples of 5. So the next one would have been $105, or the one before $95. So you can select a call option with an expiration, say, of January 2015 at a strike of $100. And all that means is that if over the next 3 or 4 months, Apple does go up and you regretted having not bought the stock, because having bought the stock you would have gained, well then you, because you actually own an options contract, you could exercise what we call exercise or activate that contract and own the stock and buy the stock at the contract that was agreed with the seller, which was at the strike price of 100. So that means that you can buy the stock at $100, and I'm assuming that in 3 months' time that it was 120, you can immediately sell out of your stock at 120, realizing a guaranteed $20 gain. Okay, so if the stock actually fell in value, you would actually lose your premium. So let's just say your premium, if we were to actually put this through, you might only have to pay a fraction, like the way you actually only paid a small margin to enter into a futures contract. With an option, you only put in a small premium. So $101,000 would have been your stock purchase price. But with a contract, an options contract, you might have only put up about $15,000. So that $15,000 is the maximum that you're going to lose. You won't lose any more than that. So if the Apple stock fell by $30, maybe realizing a $30,000 loss for a stockholder, for an options holder, you only lose the $15,000. So there's no need to put in any stop losses here, because the premium acts as a stop loss. And you can, that's why it's called an option, because you have the option to walk away from the contract and you paid for that. So in this case, if you had put up the $15,000 now with a strike price of $100, and the stock went up to $130 over that time period, you will get your $15 back plus more. $15,000 back plus whatever gains the stock actually made. Assuming a 1 for $1, you'll get an extra $30,000 as if you actually own the stock. Okay. So I'll actually put in another symbol here, and I'll just see if there's a way of buying into this. Okay, the market's closed and it's not allowing me. Oh, here we go. Okay, this might work. It's giving us the last price, which we actually saw earlier on. Okay, we have it. Okay, so I'm able to put in the limit order then. So again, I might believe that IBM has gone up in price or will go up in price. So if I believe that's going to be the case in the future, and I do not want to put up because I'm buying 1,000 IBM shares, I don't want to be putting up $186,780 worth of capital in order to buy those 1,000 shares. Remember, your 10 contracts by 100 shares each is 1,000, and that's a multiple here of my last price, which is 186,780. So rather than risking some of my capital, what I could do is buy a call option, select my expiry. I'm just going to go into, say, maybe December. I'll go December 20th of December 2014. And I will select a price that's close enough to this. The strike prices will not meet every 1 cent difference. They'll only go up in approximately multiples of $5 or $2.50, depending on the price level. So I'm going to choose $185 for my strike price. I'll mention some of these soon so that we'll have an idea as to why they're actually there. But at the moment, I'm just going to stick with my $185, which is fairly similar to the current price of $186.78. Okay, and there we see the difference between buying the stock at $186.78 and buying the equivalent of 1 share for $6.50. So I'm getting the stock, I'm able to buy 1 share for $180.28 cheaper than if you actually wanted to own the stock. And you see the contract size for the stock is obviously 1 share, but for the option it's 100 shares, and hence I'm buying 1,000 shares, the equivalent of 1,000 shares. So you, as a trader, possibly who wants to take ownership, will be paying up to 186,780. Whereas if you were an options trader, you will be buying a stock, the equivalent of a stock, for $6.50. So 1,000 of those. Okay, so that's a huge difference between the two. So you have a bid and ask, which means if you're a buyer, you're going to be paying at a slightly higher price of $6.70. Notice the days change, however. The stock actually fell $2.58, but the option fell 85 cents. Okay, so it doesn't necessarily have a dollar for dollar move. Okay, that'll only occur when you're reaching the expiration date. So because the market is closed, I'm going to put in a limit. So I could actually state, hopefully I could state my particular price here that I believe I should actually get in and get the option for. So we'll just keep it at maybe 650. And I'm going to have a good till cancelled term on that. Okay. You could have put it in a lower if you believe the stock that is going to fall even further, and you might like to put in maybe a 635 or a 595. Or if you think there's going to be a turnaround and you want to capture that uptrend movement on the open tomorrow, you might put in a slightly higher price. Okay, but I leave it at $6.50. And there's my 10 contracts at $6.50. And that's my cost, $6,550, as opposed to someone paying over 180,000 more. So there's my order placed, hopefully. And that's it. That hasn't been executed. It'll only be executed if the price is met tomorrow. So I'm just going to place a new order just to show you the expiration dates and the strikes and the differences possibly in the premiums. So again, I'll just go with, let's go with Twitter. And again, I'll choose 10 contracts. Twitter's last price, $54.94. I'll explain about it in a little while. I could buy a call option on Twitter. I'll go with the equivalent of 1,000 shares, which is 10 contracts. And I'll go also with an expiry of 20th of December 2014. And you're probably guessing the price that you're going to be buying the strike at this point. It's going to be a round number. That's maybe in multiples of $2.50 or $5 here. So I'm taking it that $55 will be available. Just scrolling down through that. Okay, $55. So that's kind of quite close to the current stock price. And that just means that if Twitter over this time period did go up in value, and I've just missed out the opportunity of having bought Twitter at 54.94 because that won't be that no longer will be available. It'll probably be, say, 64.94. So there's a $10 missed opportunity on holding the shares. But by holding the option today, you're paying over insurance, an insurance premium. So to lock in at buying this Twitter for $55. So if it did go up to, say, $65, you have the right to buy Twitter at 55, and the person or the company who sold you the option at a strike of 55 has to help you buy that particular stock for $65. 55 belonging to you because this is the price you're locked in at, plus $10 from the seller, and that'll effectively that will allow you to buy the stock, but your effective payment for the stock will be about $55. So if you see here for the options price, again, it's only a fraction. It's pretty much 10% of the price of the stock. So you paying over $54.94 for the stock, okay? And if you wanted 1,000 shares, that's just under $55,000. But you could actually leverage your position and only pay about $5,500, because each Twitter in an options market, each Twitter share in an options market is only $5.45 or $5.70 if you're going to be buying it, but this is the spot price at the moment. Okay, so you could purchase that, preview the order and so on, but I'm going to choose a different strike price. And you might notice that there's numerous strike prices, $95 and $1. And you might think, I'd like to buy Twitter for $1. Okay, but Twitter was never $1 and it was never $95. So why should these strike prices exist? Okay, and looking at well, I won't go with $1, but I might go down to a price that Twitter was once before, a $35 strike. So Twitter at $35 was a reality before. And you might like the idea of, okay, I could buy Twitter for $35, but the option premium should be higher. Because when Twitter was $35 and the stock price has gone up $20 to now about $55, whoever bought an option at $35 should realize the gains as if they actually own the stock. So the option premium that they paid for, we'll assume, was 10% of this $35, we'll say $3.50. So the options premium they paid at $3.50, they should realize the gains, because you should be able to realize those gains, because a lot of traders will actually just trade on options and they don't have any interest in buying the underlying currency or the underlying asset, or in this case the underlying stock. So clicking on the $35 strike, we should actually see a very high price for the premium. So it's $5.45 at the moment given its current stock price, because the strike price is pretty much the same as this. But at $35, we should see a different premium. It's not changing. And that should be a higher amount if it actually took into consideration the 35 strike that I actually I'll put in a preview order to see if there's any change there. Okay, we see Twitter at $35 is now $15.52. So it's a lot higher than the $5.45 that we saw at a strike of 55. So whoever had bought Twitter, bought the call option of Twitter at $35 would realize those gains. I'm just going to go back and have a look at the same options contract for Twitter. But instead of choosing a $35 or a $55 options contract, I'm going to choose one that's about maybe $85. And I'll just show you the 55 firstly before I do that. So $55 strike is $5.45, but putting on a $75 strike, someone who's buying a call option, who in their right mind would like to buy Twitter at 75, but these strike prices are available because it allows you to get into the markets at a very cheap price. So someone might have once upon a time have bought Twitter at $75 and paid a premium of say $7.50, but because Twitter might have fallen, they're going to lose their money because they bought a call option believing the stock was going to rise, and they're losing their options premium. And we can buy it from them at a cheaper price. So it's like asset prices falling, and you might like to buy them up at a cheaper price. So putting in a $75 strike allows us to buy Twitter for 70 cents a share, the equivalent of 70 cents a share. Okay, or if you're looking at your bid and ask, 71 cents a share. So that allows you to actually buy up a lot more. So if you were to buy 1,000 shares of Twitter, or 10, okay, you're talking about $700, okay, as opposed to about $55,000 or $5,500 at a strike price of 55. So that might entice you to maybe buy in a lot more Twitter shares in the options market, okay, because now you're doubling this up. You're buying, you're buying, as opposed to 10 contracts, you're now buying 20, which is 2,000, and your cost is going to be about $1,400, which is still quite low, okay? But you'll see that the days change. Okay, it's positive here for some particular reason, but you'll see that the changes will be a lot less given that you're dealing with a very small strike price. So that's a call option where you believe the stock prices were going to rise. On the other hand, and I'll just finish up with this one, on the other hand, you have what's called a put option. And a put option is one other type of options contract, but you believe prices are going to fall. And you can, again, like if shorting a futures contract or shorting a stock, you can actually make money on stock prices falling in an options contract. And in order to do that, you actually buy a put option. So you need to buy to open. So you're not shorting or selling, because the put is the term that represents selling or shorting. So if you want to, again, we'll go back to buying a put option, 10 contracts at a strike of 55, which is close enough to the current stock price. You will see the price is $4.90 as opposed to, I think it was $5.45 for the call option. Okay, so you see that there's some similarities between the call and the put price when the strike price is equal enough to the current spot price for Twitter. Okay, but if we go out to $35 with a call option, your premium was high. And the reason why your premium was high is that the stock actually increased from $35 up to 55. But if you were a put option holder and you had actually bought a put on Twitter at $35 strike, you're believing that Twitter prices will fall further. But in this case, they didn't. They increased heading towards $55, and therefore you should lose your premium. Okay, so if you look at a price of the premium now for the put option at $35 strike, it's only worth 20 cents, and this was about $15 for the call option. So you see the call option buyers gaining, the put option buyers losing, because the put buyer believed that the stock was going to fall, and they might have bought in a premium at the time, paid for an option at the time, equivalent to say about $3.50, and now they've lost most of that money. But if Twitter continues to fall back, they'll start this premium price will start to tick back upwards. But if the stock keeps on going up, okay, it still goes against their trade because they believed that the stock was going to fall, and this will head towards zero until expiration, which is the 20th of December. This will end up being zero. So looking at a $75 strike, we see the put is actually a lot higher, $24.45. Okay, and that is quite different to the call option. I think it was about 70 cents at a call option at that price. And the reason why it's a lot higher here for a put option holder is because if Twitter had happened to be $75 once upon a time and you believed it was going to fall in value, but then you could have bought a put option. It's like shorting a stock. Shorting a stock, you make money when the stock price falls. Buying a put, you make money when the stock price falls. So your premium could have been, say, $7 or $7.50 in order to participate in this particular trade. And because the stock fell to $55, there's about a $20 drop there. So you should have gained approximately the $20. So you see here, I'm assuming that was about $7.50 for the premium. So you see you're almost getting your $20, $15 to $20 gain, which is almost the same as the $20 loss on the stock. Okay. I hope that was a kind of a crash course in terms of understanding stocks, trading stocks, options, and futures. I'm just going to flick back over and see if there's any questions for anybody. Thanks, Hirak, for putting up the link for Christina, and I hope, Christina, you got in there all right. Let me see if there's any other questions. We can do this again at a different level if you wish. We could just concentrate on just solely looking at futures, maybe keeping it, if you felt the time period quite long. I think we're over just about an hour at the moment. So if you found it quite long or maybe too much to take in for those people who are quite new to trading futures and options, I could do a smaller Hangout or webinar again, just maybe concentrating on futures, another one concentrating on stocks. Or if you're quite comfortable with that, we could look at possibly some of the trading strategies that we could implement. And because a lot of these examples that I had used, I'm just assuming that I have a particular reason as to why I should actually be trading these particular stocks or these assets like oil and silver, etc. So it might be good to actually identify some of the strategies that might be used. I don't really want to get into all of this here. I know there's actually another excellent derivative that you could actually trade, which is future options, because options, as you might have realized, options seem to benefit the buyer a lot. If you were a stock buyer and the stock fell, you're going to lose an unlimited amount unless you have your stop losses put in. And in futures, if you have bought and a particular commodity and prices fell, again, you're losing an unlimited amount unless you put in a stop loss. Whereas if we saw with an option, you can restrict how much you're actually going to lose by maybe buying at a strike price that's close enough to the current stock, or buying a strike price that's a distant from the stock. Say, for example, with a call option, you might buy at a higher strike, and allows you to participate in the market for a very, very little amount of money. So that if the stock actually fell in value and you had a call position on it, the most you're going to lose is just the option premium. And in the previous case, it was 70 cents at a $75 strike, as opposed to a $5.45 premium at a $55 strike. So you can walk away from your contract, and your premium is effectively your loss. So it would have been ideal possibly to maybe have something like that in the futures market. And we have it here, a future options market. Maybe I might spend 5 minutes just wrapping things up with this future options market, because it has all the benefits of the futures as well as the options, and allows you to trade on margin, but also using high leverage positions. And what's the great thing about it is it actually gives you exposure to maybe participating in the options market in commodities and currencies, because all we see here at the moment in the options market is that we're just trading calls and puts on stocks. So on the futures, we had commodities. So you might like to use options on the commodities, which futures options allow us to. So again, your actions is to buy or to sell. And we might be interested in gold. And if you recall, the actual futures price for gold was about $12.25. And again, we might buy into one contract of gold. We're given, again, like a futures contract, we're given months to which we can participate or buy into a contract out into the future, and a call option. And because gold is about $12.25, I think, if it allows us to show it. It allowed us to show it, it should have given us a list of strike prices here. Change the date just in case. Okay, nothing's happening anyway. But what it would normally do is give us a strike price, and again, it'll give us a fraction of the current spot price of gold, which is $12.25. So say if I chose a strike price that was $12.25 as well, it'll give me an ability to enter into the gold market, maybe at a premium of, say, we just assume 10% of the current spot price of gold. So maybe $12, possibly it'll actually be a lot less. You'll be able to buy it for you'll be able to participate in buying an ounce of gold for approximately $20, which will say. So you can enter into that contract. For every ounce of gold that you're trading, in this case, we have 100 ounces because there's one contract size. Well, then if gold actually fell and you had an interest in a call option, which is gaining on the upside, you're losing when the gold is falling, but you're losing the maximum you're going to lose is the amount of the total premium that you actually put up for this particular trade. And if the gold prices are increasing, you should benefit from those increases as well. And you can participate in gold prices without having to put up all the money to actually physically own the gold. So you're again leveraging your position like the way you would have done in futures and options markets. Again, I just look back on the questions and see is there anything. Oh, how do you calculate the stop loss? Okay, that's a good question, Christine, actually. Calculating the stop loss. Let's assume that go back into the stocks again. And we'll go with IBM. Okay, so IBM is $186.78. So you might have a particular threshold to which you follow. There might be a rule of thumb that you might follow, which is a 5% maximum loss. If stocks fall 5%, you're out of there, because based on maybe historical data that you found, that if a stock hits 5%, more than likely, based on a probability analysis, it could fall a further 5 or 10%. Okay, so you might have that kind of historical back testing that you might have carried out on a particular stock. And you might identify that 5% rarely occurs if you look at maybe a normal distribution curve on this particular stock, if you were to work it out. Most typically, stock might fall, maybe IBM might fall maybe 3 or 4% before it actually goes up the way. But if it falls to 5, it's going to quickly fall another 5%. You might have that particular rationale apply to it. But the rationale regarding maybe a 5 or 6% hit on your account could be due to the amount of funds that you have, because applying a 5% loss, that you're willing to take a 5% loss on a particular trade, you just have to have 20 consecutive losses before your account is actually wiped out. So you want to try to minimize those particular drawdowns. So you can't participate in the market and maybe take on a 20% drawdown, because if you have 4 positions and all of them fell 20%, you've only got 20% of your capital left. Okay, so you're working with very little money. So you want to protect your asset, apply a certain risk management strategy, and if 5% is still too much, you might go 1 or 2%. A lot of traders actually go 1%. Okay, and other traders might like to base their stop losses on some technical analysis. Okay, and I'll just see if I can actually find something here, to which we might be able to. Okay, we just maybe look up the symbol here and we see what charts IBM gives us, because some technical analysts would actually use price data, past price information, to help predict future prices, and they use what's called a simple moving average in order to help them maybe pick out a potential stop position. There's also numerous technical functions like or indicators like resistance, support levels. So I suppose it's another webinar, if you're interested, that we could talk more about those type of ways of dealing with stop losses. If this is slow, I'll move on to the next question, because I think there's another question there. I don't want to leave everybody hanging on. Okay, it's probably something that we might like to take a look at. Am I going to upload it on YouTube? Yeah, this once I finish and stop presenting, this should be actually uploaded automatically on YouTube. So for if you needed to look back on it again. I suppose thanks very much for attending the webinar, and I'd love to hear some of your reviews to see how I can maybe possibly improve this a lot. I know there were some issues there, and that's possibly due to the limitations on people being able to jump onto the Google Hangout. So hopefully I'll get that link earlier, to which you can actually have unlimited viewers attending the seminar. So thanks very much, and good night.